Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Today we want to update you on the economy, stock market valuations, and where we're finding value for our clients' portfolios. We're filming this on the morning of July 26. Later today, it's very likely the Federal Reserve will raise the Fed funds rate by another 25 basis points. This may be the last rate hike in this tightening cycle of the past 15 months. So it's worth asking, what happens after the rate hike cycle is complete? This table shows real GDP growth for the United States during the 2 years prior to a cycle of interest rate hikes by the Federal Reserve, then real GDP growth during the hiking cycle, and finally the real growth rate in the 2 years after the hiking cycle has ended. It shows how changes in interest rate policy have a lagging effect on economic growth. Growth during the rate hike cycle is typically greater than the 2 years prior because the Fed has likely been cutting rates prior to rate hikes, and those stimulating rate cuts are still working their way through the economy as the Fed changes course to tighten. But the biggest takeaway is in the 2 years after the rate hike cycle, economic growth has slowed every time since the 1960s. The growth slowdown is meaningful, averaging more than 3%. With the current real GDP growth rate of less than 2%, it would not surprise us if real growth is stagnant for the next couple of years. The S&P 500 has performed well to start this year, but the free cash flows expected from the companies in the index has hardly changed from 7 months ago. That tells us that much of the price appreciation is coming from multiple expansion. The large cap index is now trading at around 20 times forward earnings, significantly above the long-term average of 16 or 17 times. Twice in the past 30 years we have reached this 20 times level. In April 2020, earnings estimates were at trough levels after the pandemic had stopped global economic activity. So it made sense back then that valuations looked so high on a low earnings estimate. But today it reminds us more of the late 1990s. At the start of 1998, the forward earnings multiple for the S&P 500 exceeded 20 times. 20 times is a difficult starting point to generate good long-term returns. Stocks ran higher for another couple of years into the early part of 2000, but if you jumped ahead 5 years to the start of 2003, the two major stock indices delivered zero total return, while an aggregate bond index delivered a greater than 40% total return. Stocks could keep going higher in the short term, but we're value investors and not momentum investors. On our 5-year investment horizon, many of this year's winners project to have low future returns. We're not compelled to chase. One reason we're okay waiting for stock valuations to become more reasonable is that for the first time in nearly 20 years, short-term Treasury bills deliver a real return above inflation. The top holding in our strategies is the floating 3-month Treasury bill. Its annualized yield is nearly 5.5%. For the first time since the 2000s, that annualized yield is more than 2% above the annual inflation rate. It was difficult for investors to sit out of the stock market in the 2010s and early 2020s when the U.S. Treasury yield rarely protected one's purchasing power, but that's not the case anymore. Another asset that tends to perform well in the 2 years after the end of a Fed hiking cycle is the long-term Treasury bond. This looks like the best entry point for owning Treasury bonds in the past 5 years. Speculative traders tend to be on the wrong side of changes in an asset's price. Today they are as negative about owning the 10-year Treasury as they were in the second half of 2018. We're not projecting astounding returns for the long-term Treasury, but it's worth noting that the last time the Fed stopped hiking rates in December 2018 and speculative traders were negative on long-term bonds, the 20-year Treasury bond delivered a nearly 50% total return over the next 18 months. Besides short-term and long-term treasuries, another industry we like in our high-income strategy is the oil and gas pipelines. The dividend yields of the pipeline businesses we own range from 6 to 9%. What we really like about these companies today is how much excess cash flow they are generating beyond the dividend payout. This is unlike any time in the history of this industry when overspending was usually a concern. Now the additional cash flow can be used to pay down debt, buy back stock, or increase the dividend. Last, we want to provide insight into how we are finding new ideas to buy for our stock portfolios. Even though overall market valuations are high, there are always places where you can find value in the stock market. Currently, we're finding that more in the defensive sectors. And a good example is Elevance Health, which is one of the top health insurance companies in the country. The health insurance industry is one we have followed for many years. These companies typically deliver steady growth regardless of what's happening in the economy. As a result, they provide ballast in a stock portfolio when purchased at a good price. We look at the health insurance companies over multiple presidential election cycles since their share prices can fluctuate with rumors about changes in U.S. healthcare policy. On average, Elevance has traded at around 14 times forward earnings. We were waiting for the price to fall to 12 times earnings before buying, a price that it reached several weeks ago. It can trade cheaper than 12 times, but we believe this is a good entry point while limiting our downside to less than 20% outside of a repeat of the pandemic decline. The other factor we consider with defensive stocks, besides their absolute valuation, is their relative valuation compared to the S&P 500. Investors want to buy defensive positions when the relative price-to-earnings ratio is meaningfully below the long-term average. Elevance's price-to-earnings ratio normally trades at about a 20% discount to the S&P 500. So if the S&P 500 is trading at 17 times earnings, Elevance on average would be trading at 14 times. But earlier this month, that relative discount widened to more than 35%. That's rare outside of the pandemic and gave us further conviction to add the position into the portfolio. Hopefully that gives you a sense of how we see the markets. Now that the Fed is nearing the end of its hiking cycle, we would expect economic growth to slow over the next 2 years. Stock market valuations in total look high to us, which suggests that future returns over the next half decade will be lower than what we've become accustomed to. However, we're finding pockets of value in areas like short-term and long-term treasuries, oil and gas pipelines, and defensive stocks. If you have any questions about this or would like to learn more about Oxbow, please contact us. We like to provide the information we think is most valuable for investors. If you'd like to see more videos like this, please subscribe to our YouTube channel.